Christina Brown here with the Brown team at Sage Door Realty. If you are thinking about buying a house, one of the biggest factors is being able to secure financing. How you do that is you want to have a good credit score. So let's talk about credit score and all the things that go into improving your credit. First of all, did you know that there are over 16 versions of your FICO score? So many times it comes up that a buyer will go to a dealership to get a vehicle. They're pre-approved. They get a piece of mail for a credit card. They're pre-approved. Then they go buy a house and they are declined. There are reasons. It is because each of these places are looking at a different version of your FICO score. There are factors that are more important to a lender. A lender looking at loaning you money for a mortgage to purchase a home are often focusing on different factors than the dealership or a credit card company that matter to them most if they are scrutinizing, is this person going to pay off a 30-year note on this property that's worth way more than they make. So they are looking at a specific version of your FICO score. So you have to keep that in mind. So you may be approved one place and then go for a different type of credit and not get approved. So your FICO score matters. So what are the things that make up your credit score? The most important things to know is, of course, your payment history. Pay things on time. So important, especially when you are looking at securing a mortgage. They look back a year. If you miss a payment or you are more than 30 days late on a payment, that could keep you from getting approved for your mortgage. Super, super big factor. Just pay all of your payments on time. The types of usage that you have. So they don't want to see that you have 20 credit cards and that's it. They want to see revolving credit. They want to see that you have a vehicle loan. They're looking at a varied usages of credit. So that matters. So make sure you get different types of credit. The other part to that is your amount of usage on each credit line that you have. So if you have 5 credit cards and they are all $1,000 limit and you have $750 charged on each 5 card, that can hurt you more than having one credit card with a $10,000 limit and you have $6,000 charged up on that card. That only shows 60% of usage instead of 75% of usage. So you really want to keep that down to less than 60%. If you can get it less than 30% usage on your lines of credit, that's even better. That's a big boost to your score. So that leads me into my next tip, and that is pay down your cards that have a higher percentage of a balance. When you are going to get a mortgage, that is something that you should consider. Hey, if you have a card that's at 75% of its usage, pay that down some. And then, of course, varying your types of credit. Like if you don't have a credit card, maybe open one. But an easy way to do that if you're younger and you're less established with credit is if you have a parent, they have to have good credit, that is willing to add you on as an authorized user. You then gain all of their credit history on that account. You do not have to have the card in your possession. Your name does not, like they don't have to actually give you a card. You don't have to use the card. They just need to put you on as an authorized user and you gain all of that credit. And the other thing is you might have accounts that you haven't used in the last, for over 10 years. Don't close those old accounts because it's closing off all of that history. And if you do that, your score will raise instantly. Now you can ask them to shut the cards off where you can't use them, but do not close them. Super, super important. And at the time you're getting a mortgage, they're looking at how many times you have applied for loans. Not talking about a mortgage. There is a shopping period where you can shop for a mortgage where it really shows as far as the effect to your credit score as one inquiry. So you can talk to 20 different mortgage lenders within a 2-week span, let's say, and it's to have a negative effect on you. But if you go to a car dealer and then you apply for a credit card and you're applying for a mortgage, that can hurt you. They're saying, ooh, this person's kind of going crazy here with credit. They're trying to get a bunch of money, spend money, what's going on? A great tip is, of course, check your credit score. Make sure things are accurate. If things aren't accurate, reach out to the credit bureaus, have them change it, dispute inaccurate information. Super important. You're the one that's responsible for your credit score, so take good care of it, monitor it, check it, make sure things are accurate, because there could be things on there you don't even know that are hurting your score. So those are my 7 tips. Fastest, best, easiest ways to raise your credit. If you have questions, of course, reach out. I'm always happy to help. Have a great day.